We will now going to proceed to the illustration 9, contract cost. On the left side, as you can see, we have here the problem, and on the right side, we have the solution. So first, we are going to compute the contract costs incurred during the year. To get that, first, we will have cost of materials, labor, and construction overhead, which is 1,300,000 less the incidental income, which is 20,000. That will give us the contract cost before capitalizable borrowing costs, which is 1,280,000 plus the capitalizable borrowing costs, which is 70,400. A separate computation for the capitalizable borrowing cost is stated below. And from there, we can have our contract costs incurred during the year, which is 1,350,400. We will go back to the computation for the capitalizable borrowing cost, which is 70,400. To get that, we have the interest on general borrowings. We have 6 million times 12% plus 2 million times 8%, which will give us 880,000. That will be divided to the general borrowings, which is 8 million from 6 million plus 2 million, and the total would be the capitalization rate, which is 11%. And then we should multiply it by the average expenditure, which is 640,000. To get that, we have 1.28 million divided by 2. And to get the capitalizable borrowing cost of 70,400, we should multiply the 642,000 to 11%. Next, we will going to compute for the profit for the year. To compute for that, we have total contract price of 2 million less the construction cost. Under the construction cost, we have the cost incurred to date, which is computed earlier, the 1,350,400, and the estimated cost to complete. That will give us a total construction cost of 1,600,000. That 1,600,000 will be deducted to the 2 million. That will give us expected gross profit of 400,000. From there, we should multiply the percentage of completion, which is 84.40%. That will give us the gross profit earned to date, which is 337,600. And we have 3 deductions from that, which is the rectification work not expected to be recovered, which is 130,000. We have the administrative cost of 50,000 and the selling cost of 30,000. That will give us a profit for the year of 127,600. We will now proceed to the Chapter 7 summary. We have 5 steps in the recognition of revenue from contracts. The first one, we have to identify the contract with the customer. This step involves determining whether there is a valid agreement between the entity and the customer. Next is to identify the performance obligations in the contract. A performance obligation is a promise in the contract to transfer a distinct good or service to the customer. Next is to determine the transaction price. The transaction price is the amount the entity expects to receive in exchange for fulfilling the performance obligations. Fourth is to allocate the transaction price to the performance obligations. If a contract has multiple performance obligations, the total transaction price needs to be allocated to each obligation based on its relative standalone selling price. Lastly, recognize revenue when or as A performance obligation is satisfied. Revenue is recognized when control of the promised goods or services passes to the customer. This can happen over time. Next, we have the performance obligation satisfaction, which is over time or at a point in time. Over time, revenue is recognized over time based on the progress of fulfilling the performance obligation. This is often used for long-term contracts like construction projects. And in the point in time, revenue is recognized when control of the good or service is transferred to the customer, such as upon delivery. Next, under the cost-to-cost method, the entity's measure of progress is determined using any of the following formulas. So, for the first formula of completion, for the percentage of completion, this method uses cost incurred as a percentage of total estimated contract cost to measure the progress. Next formula, for the percentage of completion, this formula provides a slightly different approach to calculate the percentage of completion. Next, under the zero profit method, when the outcome cannot be measured, if the outcome of satisfying a performance obligation over time cannot be reliably measured, revenue is recognized only to the extent of recoverable cost. This means the entity will recognize no profit until it can reliably measure the progress of the project. Next, contract costs. These are contracts directly associated with the contract. Example, materials or labor. Only costs that are expected to be recovered through the contract are included. Changes in the measure of progress and transaction price. If there are changes in the estimate of progress or the transaction price, example, due to contract modifications or variable consideration, the changes are accounted for prospectively. This means adjusting future revenue recognition, not retroactively adjusting past revenue. Contract liabilities or asset. If the entity has performed but has not yet received payment, the contract is recognized as a contract asset. If the customer has paid in advance but the entity has not yet fulfilled its obligations, the contract is recognized as a contract liability. An unconditional right to payment is shown separately as a receivable. Lastly, for the onerous contracts, when a contract becomes onerous, example, the cost to fulfill the contract exceeded the expected revenue, the entity must recognize a provision for the expected loss. This provision is accounted for under the Philippine Accounting Standards 37, which is the provisions, contingent liabilities, and contingent assets. That concludes our report. Thank you so much for listening.